Thank you for joining us today for our webinar, Capital Markets and M&A Outlook. I am Leanne Foster, Senior Associate of Kolb M&A Advisors. My colleague John Keelick and I have partnered with Pfingsten Partners to bring you both current information and insight into private equity. Our webinar today will look at how private equity fits into the M&A world, types of private equity, dispel some myths, and show the specific benefits of private equity. Joining us today from Pfingsten, we have Scott Finnegan, Managing Director. Scott is a member of the corporate finance team and involved in acquisitions, divestitures, debt and equity financing, and supporting investment management activities. Insight into the M&A outlook will be provided by John Keelick of Kolb+Co M&A Advisors. John provides buy-side and sell-side services to middle-market companies and specializes in M&A, strategic planning, operational review, and post-merger integration. I am your host, Leanne Foster, and I'm very pleased you have taken time to join us today for the webinar. Pfingsten Partners was formed in 1989 as an operationally focused private equity firm which invests in middle-market manufacturing, distribution, and business service companies. Kolb+Co M&A Advisors is a dedicated team with significant transaction experience and expertise. Our specialties include M&A, strategic planning, operational review, and post-merger integration. Before I turn the presentation over to John Keelick, I need to let you know that you are in a listen-only mode. There will be a Q&A session for both Scott and John at the end of the presentation. Please type any questions that you have into the questions box in the lower right corner of your screen. Now I will turn the presentation over to John Keelick. John is going to talk from an M&A perspective about deal flow, sponsor and strategic investors, capital raised, and capital invested.
Thank you, Leanne, and good afternoon, everyone. I'm pleased that you could join us today. Before we get into the real presentation, it was back in January when Leanne and I were deciding on topics. We really had no way of knowing that private equity would be in the forefront of the news every day. Maybe not in the best way, and hopefully today with the presentation we'll be able to dispel some of the rumors that are out there on CNBC every morning or on CNN. I think what we will see today as we go through this presentation is that in conducting our day-to-day activities on the M&A side, it is difficult to not think about or hear about private equity on a daily basis. And certainly even as we touch smaller companies, what I would call the lower middle market, it is always amazing to me how the word EBITDA or EBITDA or however they might pronounce it has become part of their daily vocabulary. In the early days, I think back, Barbarians at the Gate and KKR and some of the first, views of private equity, and it was always the very large deals. And again, as we will see today, private equity continues to play a role in almost everybody's lives, be it the business owner, be it investors, people in pension funds, who find their way investing in the private equity firms. So with that, let's take a look at how private equity has had an impact on just the deal flow. As we'll see on this slide, in particular in the 2004 to 2008 timeframe, private equity was accounting for over 30% of the deal flow. And, while this was a very heady time for transactions, and one could argue that in 2004 and maybe even 2005, the strategic type buyers were coming out of the recessionary period and not really active on the M&A side. And so, private equity took advantage of it. But nonetheless, they do have an impact in the marketplace. And I know firsthand, from knowing some deals that were done at that point in time, equity firms had the money and they were eager, And as we even see in 2000, and even though the transactions have dropped off in the recent quarter ended March 31st of this year, we'll see later on that private equity continues to put a significant amount of capital, into the M&A space. Here's a little bit, maybe bringing it down a little bit more. The company's down to $25 million, of value. You can see that, even in 2010, 2011, which were a little bit, down years on an M&A side, still coming out of the recovery from 2008, 2009 timeframe. We still had over $260 billion of funds being invested into M&A by the private equity firms, and well over 1,000 deals being completed in each of those 2 years. As this next slide even brings it down a little bit further into the transactions under $100 million. And as we can see here, private equity is coming into this marketplace, and we'll hear today from Pfingsten. This is probably the sandbox that they like quite a bit to play in, and are bringing some significant resources, to this market. And, to maybe show my bias, I think it's very positive that business owners, in the lower middle market or this middle market space, however you wish to categorize it, do have, at their disposal, private equity firms that can bring, the capital to do transactions, to give them an exit, or as we'll hear later, to give them a partial exit on a recapitalization. To me, it's, and also bring oftentimes the resources in terms of management and other expertise, that help businesses grow. So yes, am I showing my bias? You bet, but I think it's all a positive for, the M&A space. As we look at the amount of money that is available and the capital that is raised, what's not shown on the slide are, the funds with under $100 million. And for those of us in Wisconsin, we are well aware that, the majority of the private equity firms that are based in Wisconsin, all their funds are well under $100 million. And that also, so what's missing from here is, a fairly significant number of firms as well as dollars that have been raised or are committed to continually to do deals, in that middle market. But even looking at what has been raised over the last, few years, coming out of the 2008, 2009 timeframe, the money is significant. And this slide, the capital overhang, this is an important one, because as you look at it coming into 2012, there's almost $450 billion of funds to be invested, by the equity firms. And if you look at where those monies are coming from, if it's coming from the 2006 and 2007 fundraising time frame, it is going to be, for an equity firm, they need to go out and start getting this money invested fairly soon to provide the types of returns that their limited partners are looking for. And I think Scott may speak to this, but it's around a 10-year cycle, I would think, from the day money is raised to your final exit and the return of all that capital back to the limited partners.
Yeah, usually 10 to 12 years, but the investment time frame is usually in the first 5 years.
So again, as you're looking at it, the 2006, 2007 overhang at this point, their equity firms are anxious to invest, and there's no doubt about it. And I think at times we're just lacking, the right number of good, sellers out there to get more deal flow. Share of exits. the last couple of years, equity firms, being smart people, have taken advantage of, what I would say improving multiples. And there have been some early exits by the firms taking advantage of the pricing. But, they have played a role in the deal flow in 2010, 2011, and coming in 2012. Some of this is natural, based on the life of the funds and things of that nature. But again, there has been some advantageous exits to take advantage of the pricing. And maybe that's a good message again to business owners, that if equity firms are doing it because of the marketplace, something to think about at this time as well. In terms of the exits by type, we can see that that IPOs do not play a significant part in the exit activity. That we have the equity firms either selling to another equity firm, which represents about 25% of the private equity exits, or they're selling to strategic type of buyers at that point in time. So this is just, again, IPOs are, back maybe in the 05, 06, 07 time frame, as you can see from the slide, maybe played a more important role in the strategy. But now there's adequate capital out there, and maybe it's a good way to avoid some of the unnecessary scrutiny that comes with the IPOs. A little quote about the pass the baby sale. It's, I guess, a good way to put it, where they said the equity firms all meet in the little dark corner, smoke their cigars, and sell businesses to each other, I guess is how it works. But
That's exactly it.
But not really. But it's really a matter of what each of the firms are looking for, and where the money is to adequately invest. So I think overall, equity firms are important. They do play a role, in M&A, a very important role. Without them, I'm not sure what business owners would do. Oftentimes, in terms of being able to sell their companies or being able to sell their companies at a good value. It is with $450 billion on the sidelines to spend, that's a lot of capital that will be deployed and help the business owners being able to to take advantage of that. So with that, we are very pleased to have partnered up today with Pfingsten. It's a good firm that Leanne and I have gotten to know, and we are certainly pleased, Scott, to have you with us today, and look forward to your comments.
All right, thanks, John. Thanks, Leanne. Happy to be here today, and I thought we'd first start with a little bit of an overview on Pfingsten Partners and share with you about what we do and how we do it and how we're different. And then we can talk about the private equity market overall. And just as a reminder, if you do have any questions, you can type them in, and then we'll circle back at the end of the presentation and answer any specific questions that you may have. So turning the page to the overview. As you can see, Pfingsten Partners was based in Chicago, downtown. We have offices in China as well as New Delhi, India. And we've been in China for about a decade. And actually about 2 years ago, we opened up our office in New Delhi, India. And New Delhi, we're working on a lot of market entry and also some sourcing opportunities in both of those offices. And we'll talk more about that with some of our global capabilities. But really, the founding principle of the firm is not about financial engineering. The founding principle of the firm is really about creating value by combining both operational expertise as well as financial expertise. What we do is we invest in middle market manufacturing, distribution, and business service companies, and then try to grow them. And ordinarily during our investment period, we're trying to double or triple the size of the companies at least during a 4 to 7 year period. So it's about doing things, getting things done fast, and growing the companies aggressively, and funding the growth, which is another one of the differentiators, that we provide a lot of capital to the companies to help them grow. The one thing that we found back in the early days is growth and leverage, i.e. a lot of debt, They just don't mix. So our focus is on capitalizing the company appropriately, and then providing the tools and the expertise to help the business grow and truly be a value-added resource for our business partners. And that's really how we view our companies as our business partners. Really 3 ways we differentiate ourselves: our operational capabilities, global capabilities, and then by our conservative capital structures. And I'll take them one at a time. Operational capabilities, it takes a lot of different forms in our industry. Some people, they may have a consultant that they bring in. Others may have 1 or 2 people on board. We've got about a dozen operators that actually are employees of Pfingsten that are resources for the companies. And so it's about half of our professional staff. And there's experts doing lean manufacturing. There's people that have more of a sales and marketing orientation. The one common theme that all these operators have is that they've actually run businesses before. And we also have a couple of HR professionals to help supplement the middle market companies that we partner with. I'll show you that in a minute. Other resources that we bring to the table are we're huge believers in continuous improvement in the companies and funding continuous improvement training programs for the businesses. So several times a year at Pfingsten, we actually put on team leader training programs on continuous improvement, where we bring in people from all over the portfolio of companies, train them on best practices and lean and how to lead teams and how to communicate. And really, our theory there is that the more people that are believers in it, and the more people that are in the organizations at all levels, really working on continuous improvement, the better off the companies are going to be in the long run, which is why we fund those training programs. And our people here at Pfingsten really coordinate that for us. Another unique aspect of what we do is we put on best practice forums for our portfolio. Today, as a matter of fact, downstairs we've got 43 senior sales and marketing professionals at our firm, at our various portfolio companies, all in town for a two-day seminar. We have about I think 5 outside speakers, and then just talking about best practice sharing amongst our team, and things like e-commerce and social media and a lot of the new topics. Those are things that our senior sales and marketing professionals want to know about and want to hear about. And the best thing we can do is introduce all the different people in our various companies that we own. We own 18 different industry groups right now, and so we get a lot of smart people in the room and share a lot of ideas and really try to move things forward at all the different businesses.
How many total portfolio companies in those 18?
We have 18 portfolio companies.
Okay, thank you.
And then those companies have then bought. They do add-on acquisitions,
Sure.
An average of about 1 3/4 on average, or 2 acquisitions for each platform company that we. Platform company we refer to as an industry.
Sure. Okay.
So we don't do competing platforms in the same industry.
Okay.
And then finally, from the operating standpoint, we have what we call our operating bench. And it's executives that we've gotten to know and worked with in the past through the last 23 years of doing this. And in many cases, if there's an opening at a portfolio company, we can help bring in people that we know. And just recently, we brought in a VP of operations that we've worked with in the past for one of our portfolio companies that was making a change. So, one thing that we learned over the years is that working with people that you know and people that you trust makes a huge difference, because it just takes away all the risk of having to go recruit someone and not knowing them. So, you find great people and you want to continue to work with them because they create value for you. So again, we have about 200 executives on our operating bench that we keep in contact with. We do a couple events a year to maintain contact with the operating bench and really try to work with them, and they're always on the lookout for opportunities for us as well. So that's our operational capabilities. The global capabilities, as I mentioned earlier, we have offices in China, in Chang'an, which is outside of Shenzhen, if you've been over there, and then we also have offices in New Delhi, India. And what these offices do, we have global product sourcing services. So the office actually helps coordinate the process of sourcing product in Asia, and that would be logistics and quality control and finding and identifying the quality factories, and then also working on the order processing to make sure things are getting done on a timely fashion and just monitoring what's going on over there. If you've ever been over there and then sourced from Asia, you have to keep on top of it on a daily basis, and that's really what our office does for our portfolio. Market entry services, we also working on some projects and have engaged them to evaluate the markets in Asia for some of our companies that are based here in the United States. All our platforms, by the way, are headquartered in the United States, but we really take a global perspective with how we view the world. Functional support services, again, anything that needs happening over in Asia, we have offices. Some of our companies have used it resourcing a $7 million product line, for example. Others have actually used it when they're in Hong Kong or when they're in Shenzhen. They want a place to meet. They've used the office and borrowed some coffee. So at the end of the day, we're here to be a resource for our portfolio, and whatever the portfolio needs, that's what we try to provide. And then finally, with our global capabilities, we've actually done multiple international add-on acquisitions. Believe it, we've done 84 acquisitions in total at the firm since our founding. 19 of those have actually been international acquisitions, and we've even bought companies in China. And so really, again, we take a global perspective to growing our businesses. And then the third differentiator for us is capital structures. We put a minimum, and this is not in vogue just with the recession, but in the 23 years we've been doing this, we've always put at least 50% equity in every deal that we do. So we don't borrow any more than what we put in, and far more than the industry average. In fact, usually we're putting about 65% equity in our transactions. We just do a financing package that utilizes senior debt and then fill the rest with equity. And so, again, it's a conservative approach. Obviously, our investors still want their same returns and their better returns. So really the thing that we have to do is provide the value and provide the resources to the companies and provide the growth and work on the growth with the management teams to grow the businesses, which is how we create returns. And for us, growth is really the first and foremost characteristic that we're looking for, because it's fun growing businesses, and also at the end of the day, you're really creating something special when you're generating profitable growth at the businesses.
It must be tempting, though, with the cheap money that's out there right now and some of the leverage that banks are putting in deals, to borrow a little bit more.
Yeah, it might be tempting to some. We've just seen over time that the tried and true strategy is to not over-lever the businesses, provide the capital structure and the capital base to withstand all the economic conditions that happen. And the one thing that we know in businesses is that the things happen that you never expect, and we always want to have the company prepared to react. And we've never found a problem with having too much capital in a business. But what we have found is problems when the company hasn't been capitalized properly.
Sure.
In fact, in a lot of cases, some of the companies that are coming to us, they're looking for better capitalization because they've been over-levered at times. That happens in some of the cases, and then they have a hiccup in their business, and then next thing you know, they're talking to their banks once a week versus once a quarter or once a year.
Mm-hmm. Okay, thanks.
Looking at our organization, again, on the right side, heavy operational support, and you can see 12 operators. We have the transaction side on the left-hand side, which John Underwood and I co-lead. And then we've got the business development function and administrative function. So with companies that have with 18 different industry groups that we invest in, this is really the staff that helps work with the companies. And I think an interesting thing to point out with our operations folks, we don't run the businesses. Management runs the businesses. Again, what we try to be is a resource and really try to be a functional resource to help grow the companies.
Okay, great.
Global services, I'll just touch on this page quickly. Again, product sourcing, a big part of what we do over in Asia. Supplier identification, product identification, and specification. Quality assurance, a huge part of it. Logistics and shipping. Market entry, we're doing multiple projects over there, trying to assess the ability of our companies that we own here in the States to sell product into Asia. And we've also got a lot of resources on the ground in China in particular, to help us assess opportunities that we're looking at here in the States. So if we're finding a company based in the U.S., we can engage those resources on a real-time basis to help us assess what the opportunity is to expand the presence of the business over in Asia. And then, again, functional support, acquisition search, executive search, engineering, sales, and marketing. We talked about conservative capital structures. As you can see, for the last 22 companies that we've done, the average has been 65% equity. And, that's not something that we're going to be changing in the near term. And that's we're dramatically different. For every dollar that we borrow in debt, we're putting $2 in for equity. Usually the industry is the flip side of that, right, where they're borrowing 2/3 and putting 1/3 in. And again, what that allows our companies to do is take advantage of opportunities. So it maximizes their operating flexibility, provides the capacity to weather the economic storms. For example, during the last recession, we didn't lose a single company during the last recession. So the companies had the capability and the capacity to weather the storms and any competitive threats. And then in addition, it also increases our ability to close transactions. So in the vast majority of the deals we do, there's no financing contingencies because we're not looking to lever the company up. We're looking to capitalize it properly and then grow it. Some ideas on these best practices sharing forums. Again, this is getting people from all over our portfolio together to review the current state of what's going on in the marketplace and new opportunities. CIT leader training we talked about. We're doing 5 sessions a year, and anywhere from 15. Usually it's 15 to 20 participants per group. Again, from a cross-functional and all levels of the organization that are participating in that. Sales and marketing forum is going on right now. We have our systems forum coming up in July, where all the MIS professionals get together and talk about best practices and ideas and new concepts. The CEO forum, we love to have the networking with the CEOs and have them share ideas. Just last night at dinner for the sales and marketing forum, there's some new connections that were made to help grow the businesses, and it's really part and parcel of what we do is to get them all together and they can commiserate and share success stories as well and best practices. So an HR forum, very important. Supply chain forum is actually one that we've added last year for the first time. The CFOs get together once a year, and then we also have each company will have a continuous improvement champion, and we also bring the continuous improvement champions together once a year. And this page right here is really one of the major responsibilities for our operators, is to really make sure that all the companies are connected and make sure all the companies are sharing the great ideas. So if one of our company in Minnesota has a great ideas that's how to maximize their distribution efficiencies, we want to roll that out to the entire portfolio and make them aware of it. They don't have to use it. This is not something that we force on the companies, but we provide opportunities for them to see different ways of doing things, and if they choose to grab a hold of it, that's fantastic, because then everyone wins.
That's great.
Looking at our history, we were founded in 1989 and really raised the first fund in 1991. So it was a lot of friends and family and retired executives of companies that we started with. It was a $26 million fund, and over time we've just about tripled in size from fund to fund. So we raised $100 million back in 1997 and 1998. 2004 we raised $285 million. And then our latest fund, which we're a little over halfway through right now, we raised and activated the fund in 2009. And that fund, we've got 10 platform companies and are actively seeking more platform investments. Fund 3, we've bought 12 platforms, or 12 industry groups. We still own 8 of the 12, so we've sold off 4. And really with Fund 4, we still own all 10 and are aggressively trying to grow the businesses. All the businesses that we own, both in Fund 3 and Fund 4.
So basically almost $1 billion of investment.
Yep. Actually, there's even more than that with co-investment we provided and all the management investment that goes along with it. So 85% of the deals we do or deals we've done have been deals or transactions where the selling shareholders have reinvested in the combined business or the platform business as it may be. So. Both platforms and add-ons, we're big believers in. We don't mind being diluted in terms of ownership, so long as there's interested parties that want to grow the company. And in many, we've even had up to 75 different management investors in any one company. So we're big believers in having a broader group of management that are owners alongside of us.
But again, part of it, Scott, is just with your $1 billion, that's about $2 billion worth of transactions. If I think about it correctly, that
Right.
has made its way into the marketplace,
Yep.
and usually the business owners.
Well, when you talked about there's $450 billion
Yes.
available to
Yeah.
invest, on average, if you say it's just even 50% equity in a
Right.
deal, that's about
$1 trillion.
about $1 trillion
Right.
of capital, and probably more than that because a lot of people don't do a 50% equity
Right. Right.
investment in the business. So, but
Quite the impact.
our goal is not to get materially bigger in terms of fund size. Our goal is really to stay in the area where we add value, not go up market, still focus on the lower middle market, which is really where we excel and where we have fun investing and obviously have had profitable investments given the track record
Sure.
of raising the money that we've had. Looking at the history, it's been 84 acquisitions. So 32 industry groups or platform companies, and then 52 add-on acquisitions. So as I mentioned, between 1.5 and 2 add-on acquisitions per platform company. And you can see it's a pretty broad mix between manufacturing, distribution, and then service or media companies. Media was one of the earlier areas that we focused on, particularly publishing. We've really transitioned that more to a business services investment strategy now. And then our investment criteria, generally the transaction values are between $15 and $100 million, which usually translates to revenue of $20 to $150 million, and then EBITDA or EBITDA or however you want to pronounce it, of $3 million to $12 million per company to start. And then really what our goal is to double or triple the size of those businesses that we make investments in. And again, working alongside with the management team, but management is really running the company. The one thing that that is typical with a lot of private equity investment is we do require control, so greater than 51%, or 51% or greater. We have companies where we own 51%. We have companies where we've started off with 100%, but then get diluted with management. So those 100% situations are generally ones where there's a corporate divestiture, from a corporation selling a division or something of that nature.
And your add-ons could be smaller than the $20 million revenue.
Absolutely. We've done add-ons as small as $250,000, in terms of size. Again, but as you mentioned, John, the transaction values this is really platforms. So transaction values for platforms are generally in the $15 to $100 million range.
Great, thank you.
Yeah, really any size company, as long as it's a strategic fit for the business, we're willing to entertain it.
Good, thanks.
Okay. With that, we'll kind of shift over to the private equity market and talk about the private equity market in a little more detail. When we look at the market, we're really looking at more the U.S. market, which is really more applicable to kind of where our companies get acquired and the platforms investments that we make. There's over $2 trillion in capital commitments and about 4,000 private equity firms in the U.S. alone. And really, if you look at that and you compare it to the public market, the public market is about $15.6 trillion. So private equity is only about 1/8 the size of the public markets in terms of commitments. And there's probably about 5,000 listed domestic companies roughly. So of private equity with this $2 trillion in commitments, obviously it's big dollars, and some of the stats vary, John, but as we look at the world of the private equity segments, about 70% would be buyouts and mezzanine, with the vast majority of that really being buyouts, which is the category we would put ourselves into. And then the 30% of the dollars that get raised would be kind of in the venture capital world, which is really an area, early stage companies, that we really don't invest in. So we're squarely focused on the buyout segment. Looking at the common characteristics. Really the common characteristics of a private equity deal, they're privately negotiated transactions, usually negotiating with entrepreneurs. And the entrepreneurs obviously have had a long ownership of the business and have grown the business. In many cases, started the business, or it could be a second or third generation business even. So the one thing that we always understand is that it's a big honor to partner with a management team at a company and to own the business. And we don't take that lightly. And so it's always working very closely with the entrepreneurs and they're really customizing transactions to fit their needs. The investments themselves, they're longer term, and by longer term, our hold period is generally in the 4 to 7 years, with our average being about 5.5 years of ownership. But it's not liquid, so the theory is that the partnerships go in together as partners when we partner with the entrepreneurs or the management teams that are there, and then we exit as partners in many cases. If it goes to another private equity firm, they have a chance to reinvest along with the next private equity firm in a secondary sale, as you talked about earlier.
Yeah, Scott, if you could, in discussions that Leanne and I have had, about the private equity model, it is oftentimes that the fear of what happens at the second sale, after the 4 years.
Yep.
That seems to bother the owner, because he said, well, what happens to all my people, to all this, that I have built? Are you guys just going to, dismantle it, get rid of it,
Sure.
All that? Maybe you could just comment again. We're trying to educate, and maybe you could share some thoughts.
Well, I'll tell you what we focus on is we focus on building a better business.
Okay.
And, so no matter who the equity ownership of the business is down the road, if you're successful in building a great business that's out competing its competitors and is performing to the best of its abilities and making a difference in its respective industry, that's really the key. Because if you're successful in having a great management team and great people in the organization, they're going to have fantastic opportunities no matter who the equity ownership is, because what they've got is a growing business. They've got a very successful and very profitable business, and they've also got a business which is outperforming its competition. And so no matter who buys the business at the end of the day, John, the key is they're going to have to pay a lot for it, and they're not going to want to mess it up.
Okay.
So really the opportunities there's tremendous opportunities for the management teams that result in both from if it's a sale to another private equity firm or if it's a sale to a corporation. I'll give you an example of that. One of our CEOs, we sold the business in 2010. It was about a $115 million business at the time, and he's now running a $350 million division for that for the public company.
Great.
So there's great opportunities for the team and for the people.
Thank you.
The other thing, we view it as a partnership with the management teams, and we also view it as active. We're more on the active side, where we're trying to bring ideas and kind of spend time at the portfolio companies, and we do have control. Strategies vary. Industry segments could be healthcare, business services, consumer. Transaction sizes. There's funds have different sizes, different geographic focuses, different investment stages. Some firms totally focus on recaps, where the entrepreneurs want to reinvest alongside a partner, take some chips off the table. Those are great transactions. And I think what we're hearing from our investors is what's in vogue right now is an operating orientation or industry specialization, or ideally both. So an industry specialization with specific operating orientations.
Okay.
So who provides the capital for private equity? And obviously this has been a topic in the news as of late. The interesting part of it is the public and private pension funds contribute about 40% of the capital to private equity investments. So with all the news that you're hearing and how terrible private equity is over time, I mean, really the benefactors of it tend to be the public and private pension funds and there's also financial institutions, fund of funds, which are really an aggregation of capital that they manage money professionally for either high net worth individuals or institutions or endowments. Or high net worth individuals and just a whole host of other things. But if you're looking at it, really about between endowments and public pension funds, they're at least half the market.
Oh, I'm sure this will make for good debate fodder later on this year.
Yeah, rest assured it's going to be in the news every day as it has been for the last 6 months. So,
and maybe there's a slide later, but. What type of returns have equity firms been earning for the pension?
We're going to get to that in three
Great.
pages.
Thank you.
3 pages. So,
Thanks.
who makes private equity investments? It's investment professionals are resident in a lot of different places, but it's fund management firms, private equity firms like a traditional private equity firm like we would be. High net worth individuals and families, if they've sold a company and they have capital to represent, they're making private equity investments after the fact to manage their funds. Endowments of universities participate in it, and they have fund managers that can do that. And it's a whole host of others that get involved. Banks historically have been more involved. Now with all the new legislation, they're becoming less and less involved in the private equity, other than funding the debt for the transactions.
So less of a direct investment into the equity funds themselves.
Right.
Okay, thanks.
Yep. Where is it invested? Really the developed markets, meaning North America and Europe. You're talking, 70+% of the market. Asia Pacific is is obviously the developing markets, and there's been a lot of capital raised in the Asia Pacific world over the last decade. So. And a lot of funds devoted specifically to the developing markets over in Asia. So, looking at the expected return on investment, which is the next page. And this is different sources, but generally, what buyout investors expect to get would be 15 to 18% annually compounded, and expectations are always as high as you can possibly get, right? But realistically, what we've heard from sources and from investors is that if you're able to generate 15 to 18% annually compounded returns, you're doing well in the business and that's throughout all cycles. Mezzanine is obviously lower down the risk scale, but still better than debt vehicles and things like that. So the expectations there would be in the net returns to investors of 10 to 15%. Venture capital, obviously more risk, more return. So the return expectations are higher in the venture capital world, and then public equities. These are just some stats that we've pulled out of some different returns. So public equities 9%, corporate bonds 6%, and as you know, savings accounts are virtually negligible these days. So talking about private equity funding, there's really three main sources of kind of private equity firms. There's a committed capital fund such as Pfingsten's, where first you get the capital, you raise the capital, you have commitments to invest the capital, and then you find the deals and you call down the capital as needed when you're investing in the company. So a typical private equity firm such as ours, we raise capital commitments. And then when we invest the dollars over the next 5 years, that's when we call the capital from our limited partners. And so that's the majority of the private equity firms. So it's not invested immediately, it's drawn down when it's needed. There's also pledge funds or fundless sponsors. What they do is the opposite. They find deals first, and then they try to raise the capital for it. And they're able to find a company that's available for acquisition, and then they'll try to partner it with a capital provider and share some ownership in that in the process. And so there's a whole host of pledge funds and fundless sponsors that are out there as well. And so if you're an entrepreneur and you're getting courted by a lot of different firms, I think a good question to ask is, well, where does your capital come from, and is it committed capital, or do you have committed capital? Can you make commitments on behalf of the capital?
Sure.
Now, because in many cases, if you're a pledge fund or a fundless sponsor, that's not the case.
And then would that imply then that a pledge fund or fundless sponsor, their process could take longer because of the need to vet this with?
It very well could.
Okay.
For us, we already know where our capital is coming from because it's already committed to us. So we don't have to go through that extra step of raising equity capital. Some of the pledge funds have been doing it for quite a long time. They just prefer that model of not having to go and raise money. They can just do it on a deal-by-deal basis. And in many cases, they've got relationships that have invested with them for quite a while. So it can be seamless in some regards, but they don't have all the committed capital, so they still got to go, and they're dependent on raising the capital from other providers.
Are your LPs becoming pickier?
Yes.
Okay.
Yeah. Yeah. Look, they what we've heard from a lot of them is if they're going to bring on a new investor, a new fund, they're going to throw one of their funds out, so they're going to change the capital. That happens in some cases. But they're definitely trying to concentrate their investments in fewer and better investors.
Okay.
They have limited resources in terms of staff. So they can't just go and invest in hundreds and hundreds of funds. What they do is try to find best-in-class or upper quartile performers, and then put their capital behind those upper quartile performers. And that's really what we've heard from our investors.
Okay. Great.
Okay, and then finally, there's the self-funded or SBIC. That's really those are funds that are raised with SBA backing and also with high net worth individuals usually. Now, the stages of a process or a sale process, just to give a little background, usually it's a 4 to 6 month process. It can move faster than that. I mean, we've done a deal from start to finish when we first met the entrepreneur to closing the deal within 90 days. Mm-hmm. And that's going through the whole process of getting to know each other and recording. But generally, it's a 4 to 6 month process. So it's from a private equity perspective. This page is. It starts with getting some deal flow in. That could come from an intermediary, such as an investment banker, or it could come from directly targeting the industry and reaching out directly to companies. A wide variety of mechanisms to go find those deals. At the private equity perspective, in the first 20 or 30 days, you're really figuring out whether you'd like to make an offer for the business. And then what'll happen is you'll put together an indication of interest. And then, if an investment banker is representing the business, usually they'll run some management presentations where they're introducing the company to the prospective acquirers, and also introducing the management to the prospective acquirers, so they can get to know each other. What happens then? There's some preliminary due diligence that's done, and then once offers are made, and then really a letter of intent is struck. Okay. And from there, then it's financing and due diligence, and getting to closing. And again, usually the whole thing start to finish is in a 4 to 6 month time frame. So I think the pertinent point for today is that if you, given the above timing, if you really want to get a deal closed by year end this year, you really got to be pretty aggressive at it right now, because the window's closing pretty quickly.
Okay. Hear that, sellers?
A typical kind of transaction process. Sourcing and diligence. We try to use obviously we have providers that we use to help us get insights on companies, whether it's industry consultants or just people that we know and people that we've talked to. Really what we're trying to do is find what we think are the levers that we can push to create value with the business, and how can we grow it. And really during due diligence, what starts is the value creation plan, where we're really working with the company during due diligence to really find those opportunities and try to get those opportunities identified, so that once we own the business, we can really be off to the races and growing the companies. Mm-hmm. So those are the, if you think about it, then the first 100 days of ownership, we're refining those plans. But in our business, if you have a 4 to 7 year horizon, if you waste 90 or 180 days, those are 90 or 180 days you don't get back. So for us, we're really working on a lot of the planning during due diligence, so that when the closing happens and we own the company, that we can start working with the management team to implement the plans.
So at that point, Scott, and I must applaud you, because it's a nice focused way of doing a deal and having the plan in place, when the deal closes. Do you use some type of dashboard or metrics, that you share with the management team, so that they know they're on track? Yeah,
I mean, actually, the first thing that we do after we buy the company is we sit down and share the results of our due diligence with the company. Okay. With the senior management team of the business. So we sit down and share all our findings, and we have identified certain levers we think that we can push to create some value. Mm-hmm. We're smart enough to know that we don't know everything, and. Sure. 80% of what we identified might be great ideas, and 20% of it we may be off base. So with that kind of 80-20 philosophy, what we always do is try to share our philosophy with management, and make sure it makes sense for their business, because they know their business better than we ever will.
All right.
So and then if there's management changes that need to happen, our preference is obviously to work with the existing management team. With the pace of private equity and trying to grow the business aggressively, some of those managers may not be signed up for that, and so the goal is to identify where there's changes that are going to happen or need to happen early on, and then obviously be straightforward about it and work through any changes. But again, our preference is to work with the existing management teams that are in place, and that's why we do a lot of the training that we do. Okay. So a lot of the training is focused on creating best-in-class managers, and so we really work with the companies, with our operators to improve the businesses.
Terrific.
And then, really what it ges to there is, then it's about creating value, and we're big believers in sharing management, the value that gets created with the management team that's there, the senior management team that's there. And we're also big believers in having ownership, broad ownership in the company. So we could have, anywhere from 10 to 30 people that are investors alongside of us in the company. So, and the great part about that is that really the people that are making it happen on the day-to-day basis are the management teams. And if they own a piece of the rock, then they share in the benefits that get created by the successful transaction as well. For us, it's just fun to see the people that develop over the 4 to 7 years, and
Right.
and sharing the value at the end of the day. And I'd say that for us, the active periods for us are really kind of in the first 6 months of ownership. Where we're getting to know the business, because we can't really be a great partner for the company unless we really understand the business and get to know the people. And then if there's a major acquisition going on, we get involved, because we've done 84 of them. We've learned a few things over time, made a lot of mistakes, and had a lot of successes. And then we try to learn from those mistakes, obviously. And then we get involved if the company starts to underperform. We can provide resources to help the company, improve its operations or what have you. And then also we get involved on the exit timeframes as well.
Okay, great.
Okay. How are we doing on time?
We have about 3 or 4 minutes, and then
Okay.
we will want to address some of the questions that have come in.
Okay, great. Again, this next page is the different types. This is really style. So, there's we call high activism shareholders. We would put ourselves in that category because we just don't attend a quarterly board meeting and then go back to Chicago.
Right.
We actually try to provide resources to the companies. So there's certain firms that have more of a kind of an active orientation. There's kind of the other end of the spectrum, which is more just a board level, activism or low activism. So they show up for quarterly board meetings, and then there's others that are somewhere in between, and they may have a smaller operations team, but they don't have a fully developed operations team, or they may have one operating partner or what have you. But there's different styles and different ways to go about it, and I think that's really the key for an entrepreneur that's looking to partner with someone is what are they interested in, and as if they're interested in just having someone show up at a quarterly board meeting and clip their coupons, then they're looking.
It's not you.
They're looking for it's not us. And they're looking for a different partner than we would be. So we would act. We love it if people are just straightforward about it and tell us that. That's fantastic, because then we can save everyone a lot of time and effort. Because when you get into these transactions, it's really like a marriage, because you're together for 5-6 years, and let's just face it. If you have the wrong partner, life's too short. Talking about the operating partner involvement, again, we're not running the companies. Management's running the companies. But again, we try to be a value-added resource. So, at Pfingsten, how we do it is we work side by side with the operating partners and the deal partners together. And whereas the operating partners lead a lot of the daily interaction with the companies, the transaction partners lead on the transactions and help on some strategic ideas and things like that. Obviously, handle a lot of the financings and also the exit process. And so it's really kind of a partnership with both operations and transactions, which bringing both together is really the value that we bring.
Okay.
And then, really, there's a lot of different areas for operational improvement in companies, and here's a listing of some of them. The key is to find which areas are going to create the most value and which are going to create the biggest strategic difference for the company. And you can only do so many. You can only do so many things in any given year. We call it, many times what we see is a common problem at a lot of businesses. We call it chasing too many rabbits. They might be chasing 35 different projects they're working on, but none of them could get done to completion. So part of our process is bringing together a plan for management to figure out what are the 10 best initiatives to focus on for the coming year, and that's kind of the 1 year kind of tactical plan. Then the resources have to follow behind those tactical plans.
So really the 80-20, focus on the big ones.
Yep.
Okay.
And then, really the best partnership is where you have, a combination of the deal team, you have the operating team, and you have the portfolio company management all working together. And, it's open, it's candid dialogue. That's critical. And I think the biggest thing from our standpoint, you got to have a willingness to listen, because you can't make decisions unless you really listen and have all the facts.
Right.
And that's really our style, is working with the team to understand what's there, and then work collaboratively with them to make the right decision for the business.
Okay.
And going to the benefits quickly, really peace of mind. I think the biggest thing that many owners are trying to accomplish is to diversify their net worth.
Mm-hmm.
That's probably the common theme that you hear, is that they have so much of their net worth concentrated in their business, and they're not as liquid as they'd like to be, especially if there's generational transitions happening or shifts of that nature. So what the recap does, it allows the business owner to sell the majority of their business, but also retain some upside in the business. Mm-hmm. And that their risk profile, what we found is the risk profile of entrepreneurs changes over time. So as they get as they get older in life, their risk profile gets less and less. And what we can bring to the table is a regenerated risk profile to one really focused on growing the company aggressively. Because in today's world, if you're not growing, someone else is. And you really need to make each company as successful as possible, because competition is just scarce these days. Succession planning. In many cases, kids either may not be capable or they may not be interested in staying on as the next generation. So, and in many cases, also the family may not be the best option to run the business. There might be better managers out there that could do things better and faster. So. Succession planning, obviously that's a personal choice for each entrepreneur, and they've got to decide what's right for them, and then we can assist in those situations where it makes sense. But I think the biggest thing that benefits the company as well as the shareholders is growth, and in today's world you got to grow. So we have a strong desire to grow faster, and in addition to that, it's not just a desire. We actually bring the resources, both capital and operating, to double or triple the size of a business during a 5-year window. So I think we've really talked about the second bite of the apple. So if you want to move to questions, I'd be happy to answer any questions you may have.
Yeah, we do have some questions, Scott, and the first one that came up is what type of senior debt leverage are you starting to see in the marketplace?
Yeah,
I know we were talking earlier on before the before the webinar started about bankers having short memories.
right. Yeah, I mean, it obviously depends on the size of company you're talking about. I'll comment on what our range is, which is kind of the 3 million of EBITDA to 12 million of EBITDA range for the company. And usually what we're seeing is on the low end about 2 times senior on a cash flow basis.
Okay.
And on the high end, probably 3.5 times senior on a cash flow basis.
Mm-hmm.
And then, really what we're seeing is squarely in that 2 to 3.5 times. Okay. And I'd say the bulk of it's probably in the 2.5 to 3 to 3.25 times range.
Okay. And with that, with the three,
that's when I say times, that's a multiple of EBITDA.
EBITDA, just for clarification.
Yep.
Is there sub debt then that comes into your deals, or is that the seller type financing?
Yeah, we don't use sub debt or mezzanine debt in our deals, so we just do straight senior and equity. Okay,
great. A couple other questions that have come in is, when you talk about your healthcare services, mm-hmm. Maybe for the audience, what are those? What are healthcare services to Pfingsten at this point?
Well, we own a company called Garrettson, Garrettson Firm Resolution Group, which actually is a business process outsource company. So it's taking cost out of the equation in healthcare, which for healthcare, the companies that are really have long-term potential are those that are going to eliminate cost from the system, because there's been a lot of excess cost in the system. So for us, any healthcare services deals that we're focused on are really focused on those that are making the healthcare system more efficient or the process more efficient, and then also trying to reduce or eliminate cost in the healthcare system. But there's going to be a lot of changes coming up in the next 5 years in the healthcare world, and So our thought process there is the more efficiency we can bring to the equation, the better the prospects.
And we might have clarity around our healthcare system.
Yeah, people have been saying that for decades, right? I'm not counting on that, Dan.
Oh. There's a question here about, again, just getting clarification on how long you look to keep investments. Given that you're looking to make this continuous improvement and really trying to maximize value, in that transaction, is it a 5-year plan that you would like, to start and finish, or maybe you could comment on that, Scott?
Sure. Yeah. I mean, usually we say 4 to 7 years, and that's usually it's somewhere in that horizon is when we're exiting the business. I'd say the average is about 5.5 years. So what that means is that in order to make changes and improve the businesses, you actually have to fund that. And so what happens is in the first couple of years you're doing a lot of things that may not be cash flow positive to the business, to grow the business, or may end up costing something in year 1, but year 2, 3, and 4 you generate big benefits from that. So really we end up holding for about 5.5 years on average. And the biggest reason for that is that once you go through all the effort and you put in all the effort to make the business a better business, and you have great management in place, good businesses are tough to find. So our theory is we'd rather hold on longer and go for a big, stronger cash multiple of cash on return as opposed to a quick IRR. You can make 60% of your money in 1 year, but you're only going to generate 1.6 times your money. Whereas if you can hold on over over a longer term and really create more value in the business and have a lot more success in the business, you can create many more multiples of your money than that.
And there was a question that came in that I think actually it read, does Pfingsten charge finder's fees? I'm actually thinking it says, does Pfingsten pay finder's fees, per se? And Leanne didn't type this one in.
Yes, we actually do pay finder's fees for bona fide introductions to business owners. And really, and the question could have been also, do they charge fees? Does Pfingsten take fees for closing deals? And actually, we don't do that.
Right. Okay.
So many firms they'll take at the start of a deal, they'll take a finder's fee and take that money and put it in their pocket right away. But our theory on that is, at the time we bought it, we really haven't created any value.
Right.
So we don't take those fees at the front end. What we do is we get paid when the business gets sold down the road.
One last question, and this is really, from me is 2010, 2011, better years for M&A, but not great. 2012, depending on what source you read from, okay, some velocity, but again, maybe not what we all expected. As you have your, kind of look into your crystal ball, what are you thinking the next 12 to 18 months might bring for M&A, Scott?
Yeah, it's an interesting question. The one thing I'll say is that we're always wrong in what we predict. So, but I think for us, 11 was gangbusters. We did 5 platforms in 2011, and so that was a fantastic year. We're off to a slower start in 12. I think it's definitely picking up as we're sitting here today. What we thought may happen, there might be an impetus for a lot of entrepreneurs to cash out this year given the impending tax changes, that if Congress doesn't get their act together and change something, the tax rates are going up at year end. And, so for us, we anticipated that there'd be a rush of deals, after the first quarter. And frankly, that just didn't materialize. My theory on that is I think there's a little, 2010, that did materialize. When the last the sunset provision was last dealt with, and we saw a big rush at year end. In fact, we closed 2 deals on December 31st of 2010. So what we see though is we're thinking that this is just going to be kind of a business as usual, a little more aggressive the second half of the year than the first half of the year. We're starting to see multiples creep up. And we're starting to see there still is a supply-demand imbalance where there's not as much supply of good, high-quality companies as there is demand for good, high-quality companies. So my crystal ball says that the prices are going to be up. I think the lenders are going to continue to lend, and I think the lenders are going to continue to get even more and more aggressive as they have to meet their budgets. And so I think what we're going to see is pretty healthy activity in the second half of the year. Although I think with some of the uncertainty out there with Europe and China and everywhere else these days, and the election going on this year, it's kind of a murky crystal ball, I would say. So I wish I'd give you a better answer on that, John. But I think it's going to be a reasonably good period for M&A, and I think there's going to be some strong multiples paid, which should generate some good value for entrepreneurs.
Great, thank you.
I want to thank both Scott and John for their time today and for the insight that you've shared with us. And I want to give a thank you to our audience for their participation and the questions they sent in. We will be sending out a follow-up email with a link to the webinar. So look forward to receiving that from us. And again, thank you and enjoy the rest of the afternoon.